Imagine checking your next pay stub and seeing your tax rate has doubled. But instead of fixing the potholes on your street or funding local schools, every extra dollar is wired directly to a foreign corporation to pay out dividends to its shareholders. Then the scenario gets worse. Those same foreign executives use that exact tax money to walk into your local businesses and buy up all the inventory, essentially getting your products for free to sell back home for pure profit. This scenario describes the reality of the Bengal Provinces, starting in 1765. After the Battle of Buxar, the British East India Company secured Diwani rights, which granted a private merchant firm the legal authority to collect taxes from a population of millions. Before this grant, the company imported silver from Europe to pay for Indian goods. After 1765, the silver imports stopped. The company used Indian taxes to purchase the very textiles it then exported, resulting in a 100% profit margin. Diwani rights converted a sovereign economy into a corporate revenue stream. By controlling both the tax office and the trade routes, the company began using a nation's own wealth to purchase its own exports. To understand how this functioned on the ground, we have to look at the specific financial pressure placed on individual households. This chart shows the disparity between the two economies. By the 1880s, the tax burden in India reached 14.3% of total income. In England, where the revenue was being spent, the rate was just 6.93%. On a modern salary of $50,000, that 14.3% rate amounts to $7,150 seized annually. Under company rule, that money was extracted by a foreign monopoly and never returned to the local economy. Through this system, the East India Company treated the Indian population as uncompensated assets, siphoning their labor and production into private corporate accounts. Indian nationalists later defined this system as the drain of wealth. It describes a permanent one-way transfer of resources from a colony to its metropole without any commercial or material return. One of the first to quantify this process was the economist Dadabhai Naoroji. He performed a forensic audit of the British government's own colonial records to track where the money was going. Naoroji's findings were staggering. He calculated a yearly drain of 30 to 40 million pounds flowing out of India and into the British economy. To maintain a veneer of legitimacy, the colonial administration categorized these outflows as home charges. As the ledger shows, the home charges were composed of diverse line items. Indian revenue was used to pay the salaries of British officials in London, the interest on loans the company took out to fund its own wars, and the pensions of retired officers. The accounting system ensured that the Indian taxpayer subsidized the personal wealth and retirement of their occupiers, while the local treasury remained empty. These accounting entries had physical consequences that far exceeded the numbers on a page. In 1770, the company's focus on maximum tax extraction combined with merchant hoarding to trigger a catastrophic famine in Bengal. Even as millions lost their livelihoods, the company maintained its revenue collection targets. 10 million people starved to death, while company officials continued to prioritize export profits and grain speculation. When we apply modern interest rates to these annual export surpluses over 173 years, the total wealth extracted from India reaches an estimated $45 trillion. If seeing the accounting behind this wealth transfer changes your perspective on corporate history, subscribe to the channel. That $45 trillion is the capital that was diverted away from Indian industrialization, schools, and infrastructure for nearly 2 centuries. The East India Company's model was unsustainable. A corporation focused on extracting every cent of surplus value eventually destroys the stability of the population it is trying to exploit. Over the next 8 decades, the company tripled revenue collection while expanding into new territories. It dismantled local textile industries to favor British mills and imposed taxes that forced farmers into debt. By 1857, this pressure triggered a massive rebellion. The company suddenly faced a war on multiple fronts, fought by its own professional soldiers and the peasants whose lands were taxed into insolvency. The rebellion demonstrated that a corporation cannot maintain the security required for trade when its primary business is the economic exhaustion of its subjects. The war destroyed the company's financial standing, causing its stock price to collapse and its administrative structure to fail. Facing the loss of Britain's most valuable territory, the government intervened with the Government of India Act of 1858. The British Crown assumed direct control, absorbing the company's territories and its private army of 200,000 soldiers. The sovereign merchant was officially nationalized. The collapse of the East India Company serves as a warning of what happens when the profit motives of a private firm are permitted to wield the taxing and military power of a state. Hit subscribe and let us know in the comments which modern multinational corporation currently holds a level of global influence closest to the East India Company.